Hey everyone, and welcome back to the Daily Explainer. Today, we're breaking down the complete trade setup for May 18th. We are taking a highly structured, top down approach to give you the absolute best market briefing right before the opening bell rings. We've got a ton of critical data to get through today, everything from broad index levels straight down to specific stock bands. So get ready to take some mental notes. So here's the million-dollar question we're all trying to answer today. If you look at the recent price action, the Nifty 50 has been hovering right below a major 3-week consolidation range. Upward momentum is really stalling out, downward pressure is mounting, and the whole tug of war between the bulls and the bears is hitting a serious inflection point. Our job right now is to dig into the data and see exactly who might win today's battle. Here's our game plan for today. We'll kick things off with the Nifty 50 outlook. Check out the bearish trend in Bank Nifty, read through the options data, gauge the market mood and volatility, and wrap it all up with stock action and bands. Let's get right into it.
Starting off with Section 1, the Nifty 50 Outlook. Think of this as our macroeconomic weather forecast for the day.
All right, 24,000, you've got to burn this number into your brain. Until the Nifty 50 convincingly trades above this critical threshold, we are basically stuck in a completely overcast, range-bound holding pattern. Think about it. The market failed to break out of the 23,800 to 24,600 range recently. It fell 0.2% and slipped below all the key moving averages. So 24,000 is our absolute ceiling right now. If we do somehow manage to push past it, that 24,300 to 24,500 zone becomes the next big area to watch. But until then, caution is absolutely the name of the game.
Now, if the market tries to push higher today, it's going to hit immediate resistance at 23,785, followed by 23,839 and 23,927. On the flip side, we've got immediate support starting at 23,610 and scaling down to 23,469. But here's the really crucial takeaway. If the index drops below the 23,400 mark, that is a severe storm warning. Slipping below that, and specifically below the previous week's low of 23,250, means the bears are seriously tightening their grip. At that point, we could easily see the index drag down into the 23,100 to 23,000 zone.
And checking out the technical checklist here, you can see exactly why we are playing it so cautiously today. Technical analysts are actually calling this a special formation of weakness. First off, the Nifty 50 formed a bearish candle with an upper shadow on the daily charts, which is a direct indicator of selling pressure every time the market tries to move higher. We're also sustaining below all key moving averages, which, by the way, are trending downward. And the Fibonacci levels? We've broken below both the 23.6 and 38.2% marks of the April rally. Throw in an RSI sitting at a pretty weak 45.13 and a negative MACD, and you literally have a textbook setup for continued weakness. Moving right along to Section 2, the Bank Nifty bearish trend. Let's see how the major financials are looking. Well, Bank Nifty is definitely flashing some serious warning lights. It closed at 53,710, taking a 0.77% hit. But more importantly, it formed a red candle completely within the previous day's trading range. Just like the broader Nifty 50, the banking index is sustaining below all its key moving averages with a clear downward bias. It has even fallen below the 38.2% Fibonacci retracement levels for both the recent April rally and that broader correction we saw from February to April. This kind of price action is a solid confirmation of a sustained bearish trend. So where are the lines in the sand for banking stocks? We're staring down a wall of resistance starting at 54,154 and stretching all the way up to almost 54,600. Support kicks in lower down, right between 53,622 and 53,191. And just to validate what we saw on the price charts, the underlying momentum is practically running on fumes. The RSI for Bank Nifty is sitting at just 41.60, firmly below its signal line, and the MACD is showing persistent weakness. Long story short, if you're trading banking stocks today, you absolutely must respect these pivot points. All right, let's pivot to Section 3, reading the options data. We're shifting from price action over to actual trader positioning. The sheer scale of the tug of war happening in the derivatives market right now is wild. Look at the Nifty bears side. The maximum call open interest is towering at the 24,000 strike with a massive 1.03 crore contracts. This completely backs up what we discussed earlier. 24,000 is a heavily fortified resistance wall. On the flip side, the bulls had built their base at the 23,000 put strike, which holds 89.91 lakh contracts. So this 23,000 level is acting as the ultimate floor right now. Traders are very clearly boxing the index in between these two major extremes. Now, with Bank Nifty options, it's a slightly different flavor. The maximum call open interest, the overarching resistance, is sitting up at the 55,000 strike with 6.9 lakh contracts. But what you really need to pay attention to is the aggressive call writing that just popped up at the 54,000 strike, adding 2.1 lakh new contracts. Bears are fiercely defending 54,000. Meanwhile, maximum put open interest is also right there at the 54,000 strike with 8.47 lakh contracts. So, without a doubt, 54,000 is literally ground zero for banking stocks today. Let's zoom out a bit for Section 4, Market Mood and Volatility. Time to take the market's psychological temperature. Just a quick refresher on the put-call ratio, or PCR. When this number drops down towards 0.7 or 0.5, it tells us traders are aggressively selling call options. Basically, they're betting the market isn't going up anytime soon. It's a highly defensive, deeply bearish mood. And well, that's exactly the vibe right now. The Nifty PCR just took a noticeable nosedive, falling from a fairly bullish 1.17 down to 1.01 in the previous session. While we aren't in that deep bearish territory of 0.7 just yet, the trajectory is crystal clear. Bullish sentiment is actively cooling off, and traders are definitely losing their appetite for upside risk. This cooling sentiment totally tracks when you look at the India VIX, which is our primary gauge for expected market volatility. The VIX has crept up by almost 1%, pushing to 18.79. It's hovering right around its short and medium-term moving averages. For the bulls to regain any real sense of confidence, we desperately need to see this volatility index drop back below 17. On the flip side, if we see the VIX cross above the 20 mark today, that represents a significantly high risk for anyone holding long positions. The market is definitely getting jittery. Finally, we've made it to Section 5, Stock Action and Bands. Let's see what's happening at the micro level right beneath the surface of the index. Diving into the overall market breadth, it's painting a really cautious picture. Only 36 stocks saw long buildups, meaning an increase in both open interest and price. But on the other hand, a massive 76 stocks saw long unwindings, where traders were basically bailing on their bullish bets as prices fell. Even more telling, 72 stocks experienced short buildups, meaning fresh, aggressive bearish bets were hitting the tape. The sheer volume of long unwinding and short buildups completely overshadows any bullish activity, totally confirming that overarching bearish momentum we've been tracking. Quick heads up for the derivatives traders tuning in. Keep an eye on the F&O ban list for stocks crossing 95% of the market-wide position limit. Today, we have no new additions to the ban list, and nothing has been removed. However, Kaynes Technology India and SAIL are both still stuck in the F&O ban. You absolutely cannot initiate fresh derivative positions in these specific stocks today, so make sure to adjust your trading strategies accordingly. Wow, okay, we've covered a ton of ground today, from that unyielding 24,000 resistance on the Nifty, to the weak technicals, the cooling PCR, and the sheer volume of short buildups in individual stocks. The data is heavily stacked towards a cautious, range-bound, and potentially bearish stay. So I'm going to leave you with this. With mounting resistance and momentum clearly fading across the board, how are you going to position your portfolio today? Thanks so much for joining me on this deep dive. Have a fantastic trading day, stick to your data, and we'll see you in the next explainer.